All right, let's get right into it. We're going to talk about something that's probably the biggest destroyer of wealth out there, but nobody really likes to admit it, and that's your own emotions. Yeah. So today, we're going to figure out why this happens, and more importantly, build a simple playbook you can use to fight back. Come on, let's be real for a second. Have you ever done this? The market's tanking, your heart's pounding, you're looking at your portfolio, and you just smash that sell button to make the pain go away. And then what happens? Almost like it's scripted, a few days later, you watch that same stock just rocket back up. And there you are, stuck on the sidelines, just kicking yourself. It's a terrible feeling, and it's a story that's way too common. But here's the thing, and this is really important. That wasn't you being weak. That wasn't a dumb mistake. That was your brain doing exactly what it evolved to do. The problem? Well, that programming is ancient, and it's just not cut out for the modern stock market. Okay, so let's get into the nitty-gritty of why this happens. Why do super smart people make what seem like totally irrational decisions with their money? It really all boils down to this conflict between our old school survival brain and modern investing logic. And this slide just nails it. Think about it. Thousands of years ago, if you saw a tiger, what happened? Your brain flooded with panic and it screamed, "Run." And that saved your life, right? Well, fast forward to today. A 15% drop in your portfolio triggers the exact same chemical reaction, the exact same fear. But here's the glitch. In investing, running is almost always the worst possible thing you can do. And this isn't just some abstract idea. It has a real, measurable cost. Check this out. There's this long-running study by a company called Dalbar, and they found that the average investor, the regular person, underperforms the market by a crazy 4% every single year. And it's not because they're bad at picking stocks, it's because they make emotional decisions. Now you might think 4%, what's the big deal? Well, let me tell you, when you compound that over 20 or 30 years, it is absolutely massive. We're talking hundreds of thousands of dollars just gone. That's the difference between retiring comfortably and having to worry. That's a kid's college education just evaporated because of these predictable emotional reactions. Okay, so if we're gonna beat this thing, we've gotta know what we're up against, right? We have to know our enemy. So let's break down the 5 most common emotional traps that snag pretty much every investor at some point. All right, first up, the classic. FOMO, fear of missing out. You've been there. A stock is going to the moon, everyone's talking about it on social media, and you just get that feeling like you're being left behind. So you jump in. But what usually happens? You're buying right at the top. You're the last one to the party, and the smart money that got in early, they're selling to you. And trap number 2 is the exact opposite, panic selling. The market dives, that ancient tiger brain kicks in, and you sell everything just to stop the bleeding. But here's the brutal, brutal truth. Most of the market's biggest gains happen right after the worst days. If you sell and sit on the sidelines, you miss that entire rebound. You can literally cut your long-term returns in half just by missing a handful of the best days. Which brings us to trap number 3, and this one's fascinating. There's Nobel Prize-winning research on this. It shows that the pain you feel from a loss is literally twice as powerful as the good feeling you get from a gain. They call it loss aversion. And what does it make us do? It makes us hold on to our losing stocks for way too long, just hoping they'll break even, because hitting sell makes that loss feel real, and it just hurts too much. And then there's trap number 4, good old overconfidence. You make a couple of lucky bets, they pay off big, and suddenly you feel like you're the next Warren Buffett, right? You think you've cracked the code. So you start trading more often, taking bigger risks, but the data here is absolutely crystal clear. The more you trade, the worse your returns tend to be, period. And finally, we have the herd mentality. It just feels safer to do what everyone else is doing. It's a comfortable feeling. But in investing, if you're hearing about a hot tip on the nightly news or from your neighbor, I guarantee you the big money has already been made. The crowd is almost always late to the game. And really, who said it better than the man himself, Warren Buffett? Be fearful when others are greedy, and be greedy when others are fearful. I mean, that one sentence is basically a PhD in behavioral finance. It's all about going against the grain, thinking for yourself, and seeing the market's emotion as an opportunity, not as a signal for you to follow. So the big question is, how do you actually do that? How do you become the person who's buying when everyone else is panicking? Look, it's not about having superhuman willpower. It's about having a system. So let's build one right now, your personal emotional defense system. Okay, here are 6 rules. They're simple, but they are incredibly powerful if you actually use them. Number 1, Write down your rules before the chaos starts. Decide why you own what you own and what you'll do when things get rocky. 2. Automate everything you can. Set up those automatic deposits. It takes the emotion right out of the equation. 3. The 48-hour cooldown rule. You get that itch to panic sell or FOMO buy? Force yourself to wait 2 full days. Just wait. 4. Stop checking your portfolio all the time. Seriously, for a long-term investor, once a quarter is more than enough. 5. When you do feel that panic rising, you need to zoom out, and we're going to show you exactly what that means in a sec. And finally, number 6, get an accountability partner. A friend, a spouse, anyone who can grab you by the shoulders and remind you of your own plan when you're about to break it. And this right here is what zooming out actually looks like. Look at this chart. Every single one of those terrifying, world-ending crashes, the dot-com bubble, the 2008 financial crisis, the COVID crash, what do they look like now? They're just little blips on a long, steady climb upwards. The market has recovered from 100% of its past crises. Every single one. So after all this, what's the real secret? What's your true financial edge? What is the one thing that separates the people who succeed over the long run from everybody else? It's actually shockingly simple. Here it is. The market is always going to be unpredictable. You can't control it. Nobody can. But your behavior, that doesn't have to be. You can control that. And that is your only real sustainable advantage in this game. The people who build incredible wealth aren't necessarily market geniuses. They're just incredibly disciplined. They made a plan, and they had the guts to stick with it through thick and thin. So I'll just leave you with this one question to think about. After everything we've talked about today, what's your biggest financial risk? Is it really the market? Or is it maybe the person staring back at you in the mirror? Because mastering that person, well, that's the real key to winning the game.